Hi, my name is Justin Botillier, partner at Calyx CPAs, located in Medford, Oregon. Today I want to talk to you about choosing the right tax entity for your cannabis business. Now, for regular small businesses just getting started, I highly recommend what's called the LLC. Many of you probably know that about the LLC. People recommend using the LLC. What they don't explain to you is that the LLC is a legal entity and not a tax entity. So you kind of need to be clear about that. Also, LLCs are historically known for being partnerships. And so if you go to the Secretary of State, you're at your state, and you file for an LLC, chances are you're going to end up either being a sole proprietorship if you apply for an LLC but don't choose to be taxed as another entity. And if you're more than one owner and there's two or more of you, and you file for an LLC, your now tax entity is going to be a partnership. Those are the default entities. Again, there's a lot of different kinds of entities at the state level, the legal level. They can range from the PC to the LLP to the LLC to the Inc. to the, there's all numerous kinds. And so you just want to understand that when you're choosing a tax or an entity, that when you go and file that document with the lawyer or with the Secretary of State, you're choosing a legal entity and not necessarily a tax entity. So it's important to understand that when you choose a legal entity, you also need to choose a tax entity. Now, the IRS only recognizes businesses as 4 different kinds of tax entities. You've got your sole proprietorship, you've got your partnership, you've got your S corporation, and you have your C corporation. For you farmers out there, even a farm is actually kind of a sole proprietorship, or you can file a farm return within an S corporation return or a C corporation return or even a partnership. That is less a tax entity and more of just an industry that you're filing your tax return under. But really there's only 4: sole proprietorship, you've got your partnership, you've got your S corporation, you've got your C corporation. Otherwise, you can be a host of different legal entities, and you are going to end up being one of those 4 tax entities. So it's really important for you to know what is your legal entity and what is your tax entity, and to really know the differences and the pros and cons of these various tax entities. I typically recommend that you go and you file with your Secretary of State as an LLC in the state of Oregon. It's very simple filing. It costs $100, and you're off to the races, and you really only have to renew your Secretary of State registration once a year, and it costs $100, and there's no additional tax on that unless you choose to be taxed as a partnership, in which case there's a $150 excise tax. For the S corporation, the same, and then the C corporation actually pays its own taxes and isn't passed through to the owners of the business. And I'll get into that here really soon. So I want to let you know the different kinds of tax entities there are. So the sole proprietorship is the default entity for an individual. So if you go and start doing business out there in the world, you immediately become a sole proprietorship and are expected to file taxes as such on what's called the Schedule C on your personal return. Many of you probably understand, or if you're a farm, you would file what's called a Schedule F. So then the next entity is a partnership, and that's the default entity for having 2 or more owners. You do have to file what's called a 1065. That is the partnership form. And again, the legal entity doesn't matter. If you're doing business with more than two or more people, then you would file a partnership return. Then there's the S corporation, which is also a pass-through entity. So both the partnership and the S corporation, those tax returns generate what's called a K1, and that money or that report goes to the individual's tax accountant, and that K1 is, and the income or the losses on that tax return are reported on the 1040 on the personal tax return. Finally, there's a C corporation. Now, the C corporation actually pays its own taxes, and the activity or the net income or the losses of the C corporation do not flow through to the personal tax return, like the partnership or the S corporation. So those are very important designations. Now, an important thing to note is that the sole proprietorship and the partnership are also subject to what's called self-employment tax. A lot of people get blindsided when they're newly employed or newly self-employed. They don't talk to their accountant about the ramifications of self-employment tax. What that is an additional tax called the self-employment tax. It's 15.3% federally, and that gets added to the total tax liability of a person's personal income tax return. So not only are you paying the federal income tax and the state income tax, you're going to also end up paying the self-employment tax on the net income of your business. So it's really important to know and be prepared for that tax, because a lot of people don't recognize it. And it doesn't matter how much money you have in medical and how many kids you have, you're going to end up paying that self-employment tax. And so you need to remember to plan for that. And what that self-employment tax is actually, it takes the place for a business owner, the Medicare and Social Security tax that employees pay. And so when you're an employee, the employee has to have, the employer pulls some money for Social Security and Medicare tax out of that person's paycheck every time they're paid, and then they also match that money so that so the employer pays some Medicare and Social Security for that employee, and that all gets paid to the taxing authorities. But because it kind of comes out slowly for the employee, it's not typically missed, unlike a small business owner who hasn't taken any money out and put it aside to pay this tax, might get to the end of the year and then pay gobs of tax all at one time because they weren't taking into consideration that they were going to have to pay the self-employment tax. And it doesn't matter how much you make, you're going to pay 15.3% on the bottom line of whatever it is that you ended up reporting in your tax return. And so you pay federal income tax, state income tax if your state has it, and the self-employment tax, and it often can blindside people. So that's why you need to be prepared for that. Partnerships are the same. Partnerships get the 1065 gets filed, the K1 flows over to the personal tax return, and self-employment tax will be assessed if those partners are active. So sometimes they're investors, and investors are a little bit different, but if you're active in a partnership, then your income is also subject to self-employment tax. So you got to watch out for that. Now, an S corporation is a little bit more of a rigid tax entity in that you can only pay the officers' distributions and draws and whatnot based on their percentage ownership. And there's a requirement for a reasonable wage, but for farmers, that's fairly low typically. So I often recommend this. But what's nice about the net income of a S corporation is that it isn't subject to self-employment tax. So you do pay the officers a little bit of a wage. They get a W-2 that gets reported on their personal income tax, but the distributions of that, they are not taxed anyway, but the net income after expenses, whatever the net is, and whatever is on that K1 is not subject to self-employment tax. So the S corporation is I really like it. It is also has very low risk for audit. So depending on the complexity of your business, and the sophistication that you have, you may want to stay like partnership level and absorb those self-employment tax. If you are more sophisticated and you can comply with the requirements of the S corporation, I highly recommend that. And then sometimes there is C corporations, and C corporations are really good with, say, like dispensaries who are really under a tax hit for 280E because everybody's considering their overhead as or their payroll and their facility costs and overhead, and there's been tax court cases and all sorts of stuff saying that the dispensary owners can't deduct that kind of expense, which puts them in huge effective tax rate. The C corporation may be better, and the reason why is because if they get nailed in an audit, then the tax stays with the C corp, the actual entity. So that's why I like the C corporations for dispensaries. But for other businesses in the cannabis industry, particularly sole partnership, S corporation is my favorite. But if you got a lot of partners, then maybe the S corporation is not so good. Then you want to do, you know, just stay a partnership, absorb some extra tax and whatnot. And then for relatively unsophisticated farmers, single-owned operated farms, you just do a Schedule F on, or I'm sorry, a Schedule C actually for cannabis, for the cannabis industry outside of hemp. For the illegal cannabis industry, which is marijuana farms, you have to actually file a Schedule C, and you can't file what's called a Schedule F. So again, Justin Botillier, I hope that I was informative.